Moving on from money market mutual funds, let's talk about equity funds. And equity funds own stocks. So they're also called stock funds, and they can be active or passive, meaning they can track an index or the manager can try to buy the best stocks. They can be open or closed, meaning the manager or sponsor will issue or redeem new shares, or the shares have to be traded on an exchange. Equity funds are classified as a general equity fund and then have a style, large cap, mid cap, small cap, value, blend, or growth, or they can be broad market as well and not have a style, but the total market fund. If they're not general funds, then they're sector or industry funds, or maybe they're a geographic region, or maybe some level of economic development, like an emerging market type thing. Bond funds own, debt instruments, bonds, and they're usually categorized by the type of issuer. So you'll have a treasury bond fund or a corporate bond fund, and the treasury fund will own treasuries or agencies, and they'll often be categorized by maturity. And so you'll have a short-term treasury fund, which owns 5-year, and a medium-term, which owns 10-year, and a long-term treasury fund, which owns 20-year. And you might have a corporate bond fund. Again, it might be categorized by maturity as well, but it'll also be categorized by the credit quality of the bonds it owns. So high quality or investment grade versus high yield or non-investment grade, also called junk. There will also be municipal bond funds, which is a very common way for people to take advantage of these very, very small issue, very illiquid muni bonds, or there might be funds that buy mortgage-backed securities. International funds are funds that hold both stocks and bonds, and just the definitions that are used: global, if you see a fund that's a global fund, it includes US, but if it's called an international fund, then it holds no US. And you might have a global fund that has global stocks and bonds, or just stocks or just bonds, and the same with international. And they could be regional, like EU or Asia or emerging markets, and so that's how international funds work. And certain funds hold both stocks and bonds. And there's 3 main categories. The first are called balanced funds. And a balanced fund will have a relatively stable portion of stocks and bonds. And so the fund will say, we are a 60-40 balanced fund. And if the returns of stocks exceed the returns of bonds, then they will reallocate and sell some of the stocks to buy more bonds to maintain this very stable 60-40 portion. An asset allocation fund, if it says asset allocation fund in the name, that means the fund attempts to earn superior returns by varying the asset class allocations. And so it may decide that it's no longer time to hold 60-40 stocks to bonds. It wants to be 70-30 or 80-20, and it will rebalance in order to engage in more aggressive market timing. That's the difference between a balanced and an asset allocation. The third type of fund that holds stocks and bonds, and we've talked about this a little bit, is a target date fund. And the fund has a date, for example, 2050, and the idea is the fund will be held by those expecting to retire in 2050. And the funds will allocate money based on this retirement date. The longer the time to retirement, the more stocks, and the shorter the time, the less risky, more bonds and more cash. Okay, we'll come back and we'll talk about fees.